Investment versus speculation. Results to be expected by the intelligent investor. This chapter will outline the viewpoints that will be set forth in the remainder of the audiobook. In particular, we wish to develop at the outset our concept of appropriate portfolio policy for the individual, non-professional investor. Investment versus speculation. What do we mean by investor? Throughout this audiobook, the term will be used in contradistinction to speculator. As far back as 1934, in our textbook Security Analysis, we attempted a precise formulation of the difference between the two, as follows. An investment operation is one which, upon thorough analysis, promises safety of principal and an adequate return. Operations not meeting these requirements are speculative. While we've clung tenaciously to this definition over the ensuing 38 years, it is worthwhile noting the radical changes that have occurred in the use of the term investor during this period. After the great market decline of 1929 through 1932, all common stocks were widely regarded as speculative by nature. Leading authorities stated flatly that only bonds could be bought for investment. Thus, we had then to defend our definition against the charge that it gave too wide scope to the concept of investment. Now our concern is of the opposite sort. We must prevent our listeners from accepting the common jargon which applies the term investor to anybody and everybody in the stock market. In our last edition, we cited the following headline of a front-page article of our leading financial journal in June 1962. Small investors bearish. They are selling odd lots short. In October 1970, the same journal had an editorial critical of what it called reckless investors, who this time were rushing in on the buying side. These quotations well illustrate the confusion that has been dominant for many years in the use of the words investment and speculation. Think of our suggested definition of investment given before, and compare it with the sale of a few shares of stock by an inexperienced member of the public, who does not even own what he is selling, and has some largely emotional conviction that he will be able to buy them back at a much lower price. It is not irrelevant to point out that when the 1962 article appeared, the market had already experienced a decline of major size, and was now getting ready for an even greater upswing. It was about as poor a time as possible for selling short. In a more general sense, the later used phrase reckless investors could be regarded as a laughable contradiction in terms, something like spendthrift misers. Were this misuse of language not so mischievous? The newspaper employed the word investor in these instances because, in the easy language of Wall Street, everyone who buys or sells a security has become an investor, regardless of what he buys or for what purpose, or at what price, or whether for cash or on margin. Compare this with the attitude of the public toward common stocks in 1948. When over 90% of those queried expressed themselves as opposed to the purchase of common stocks. About half gave as their reason, not safe, a gamble, and about half the reason, not familiar with. It is indeed ironical, though not surprising, that common stock purchases of all kinds were quite generally regarded as highly speculative or risky, at a time when they were selling on a most attractive basis, and due soon to begin their greatest advance in history. Conversely, the very fact they had advanced to what were undoubtedly dangerous levels, as judged by past experience, later transformed them into investments, and the entire stock-buying public into investors. The distinction between investment and speculation in common stocks has always been a useful one, and its disappearance is a cause for concern. We have often said that Wall Street as an institution would be well advised to reinstate this distinction and to emphasize it in all its dealings with the public. Otherwise, the stock exchanges may someday be blamed for heavy speculative losses, which those weighted index of 500 stocks rose from 58.11 to 92.15. Or 58%. Obviously, the second group had proved a better buy than the first. But who would have been so rash as to predict in 1960 that what seemed like a miscellaneous assortment of all sorts of common stocks would definitely outperform the aristocratic 30 tyrants of the Dow? All this proves, we insist, that only rarely can one make dependable predictions about price changes, absolute or relative. We shall repeat here without apology, for the warning cannot be given too often, that the investor cannot hope for better than average results by buying new offerings, or hot issues of any sort, meaning thereby those recommended for a quick profit. The contrary is almost certain to be true in the long run. The defensive investor must confine himself to the shares of important companies with a long record of profitable operations and in strong financial condition. Any security analyst worth his salt could make up such a list. Aggressive investors may buy other types of common stocks, but they should be on a definitely attractive basis, as established by intelligent analysis. To conclude this section, let us mention briefly 3 supplementary concepts or practices for the defensive investor. The first is the purchase of the shares of well-established investment funds as an alternative to creating his own common stock portfolio. He might also utilize one of the common trust funds or commingled funds operated by trust companies and banks in many states. Or, if his funds are substantial, use the services of a recognized investment counsel firm. This will give him professional administration of his investment program along standard lines. The third is the device of dollar cost averaging, which means simply that the practitioner, because the experts frequently go astray in such forecasts, it is theoretically possible for an investor to benefit greatly by making correct predictions, when Wall Street as a whole is making incorrect ones. But that is only theoretical. How many enterprising investors could count on having the acumen or prophetic gift to beat the professional analysts at their favorite game of estimating long-term future earnings? We are thus led to the following logical, if disconcerting, conclusion. To enjoy a reasonable chance for continued better-than-average results, the investor must follow policies which are 1. Inherently sound and promising, and 2. Not popular on Wall Street. Are there any such policies available for the enterprising investor? In theory, once again, the answer should be yes, and there are broad reasons to think that the answer should be affirmative in practice as well. Everyone knows that speculative stock movements are carried too far in both directions, frequently in the general market and at all times in at least some of the individual issues. Furthermore, a common stock may be undervalued because of lack of interest or unjustified popular prejudice. We can go further and assert that in an astonishingly large portion of the trading in common stocks, those engaged therein don't appear to know, in polite terms, one part of their anatomy from another. In this audiobook, we shall point out numerous examples of past discrepancies between price and value. Thus it seems that any intelligent person with a good head for figures should have a veritable picnic on Wall Street, battening off other people's foolishness. So it seems. But somehow it doesn't work out that simply. Buying a neglected and therefore undervalued issue for profit generally proves a protracted and patience-trying experience. And selling short a too popular and therefore overvalued issue is apt to be a test not only of one's courage and stamina, but also of the depth of one's pocketbook. The principle is sound. It's one. As more people learned about the January effect, more traders bought small stocks in December, making them less of a bargain and thus reducing their returns.